Alright, before we dive in, a quick but critical heads up. I am not a licensed financial advisor, loan officer, or real estate professional. This video is for educational and entertainment purposes only, and should not be considered financial, legal, or real estate advice. The mortgage landscape changes constantly, and your financial situation is unique. It is absolutely essential that you consult with a qualified and licensed professional before making any decision about your home loan. Your home is likely the biggest purchase you will ever make, so do your own research and get personalized advice. Now let's talk about the moment your dream home turns into a living nightmare. Picture this, you did it. After months of searching, you found the one. The perfect house in the right neighborhood, with that backyard you've been dreaming of. You got pre-approved, you put in a strong offer, and against all odds in this crazy market it was accepted. You're on cloud 9. You've ordered the paint swatches, you're measuring for new furniture. You're telling your family the good news. Then the silence begins. Your loan officer, the one who was so responsive when you first applied, is now a ghost. Emails go unanswered. Voicemails are never returned. Your closing date is 3 weeks away, then 2, then 1. And you have no idea if the single most important piece of the puzzle, the money, is actually going to be there. Your real estate agent is getting nervous. The seller's agent is calling with threats to put the house back on the market. And your entire life savings, your earnest money, is on the line. That feeling of pure joy has curdled into a knot of pure panic in your stomach. This isn't a scary story I made up. This exact scenario, in thousands of different variations, happens every single day across America. And it almost never has to do with the buyer's qualifications. It has to do with the lender they chose. The single biggest financial decision of your life isn't just about the house. It's about the institution you trust to finance it. Choosing the wrong one can cost you not just the house, but thousands of dollars in hidden fees, years of higher payments, and a level of stress you wouldn't wish on your worst enemy. That is why we're here today. We are going to pull back the curtain on two of the biggest names in the entire mortgage industry: Rocket Mortgage and Guild Mortgage. This isn't just a surface-level review. This is a deep, comprehensive, no-holds-barred breakdown. We're going to dissect their processes, expose their fee structures, analyze their customer service models, and by the end of this you will know with absolute certainty which of these giants is the right choice for you. This is your playbook for avoiding that nightmare scenario and walking into your closing with confidence, knowing you got the best deal possible. So let's meet our contenders. In one corner we have the undisputed heavyweight champion of technology and marketing, Rocket Mortgage. You can't watch TV for an hour without seeing one of their commercials. They've blanketed the airwaves, the internet, and even sponsored the Super Bowl. Their promise is intoxicatingly simple: push button, get mortgage. They represent the new school, the tech-first disruptor that took a clunky, paper-intensive, old-fashioned industry and promised to make it as easy as ordering a pizza. Rocket Mortgage, which is the public-facing brand for Quicken Loans, didn't just stumble into success. They engineered it. Their founder, Dan Gilbert, saw an industry bogged down by fax machines, snail mail, and slow, inefficient processes, and he poured billions into creating a centralized, streamlined, digital-first machine. Their entire philosophy is built on speed and convenience. They want to take the intimidating, confusing world of mortgage lending and distill it into a slick, user-friendly app on your phone. Think about it. From the comfort of your couch at 10 o'clock at night, you can upload your documents, link your bank accounts, and get a pre-approval letter in minutes. You can track your loan's progress in real time on a clean, simple interface, watching little check marks appear as you move from underwriting to appraisal to closing. Feels empowering. Feels modern. Feels like you are in total control. For many people, especially those who are tech-savvy and value efficiency above all else, the Rocket Mortgage experience is a revelation. It removes the friction, the awkward phone calls, the endless trips to a stuffy office. It's a direct appeal to our modern desire for instant gratification and on-demand service. They have fundamentally changed what people expect from a mortgage lender. But then, in the other corner, we have the seasoned veteran, the quiet professional, Guild Mortgage. Guild doesn't have the flashy Super Bowl ads or the celebrity endorsements. They represent the old school, but refined for the modern era. Their philosophy isn't built on apps and algorithms. It's built on people and relationships. Founded way back in 1960, Guild Mortgage has weathered every storm the economy has thrown at it for over 6 decades. They've seen interest rates at 18% and at 2%. They've navigated housing booms and housing busts. Their model is fundamentally different from Rocket's. Instead of a centralized, national call center, Guild operates through a network of local branches and individual loan officers. When you work with Guild, you're not just a number in a system. You are a client of a specific person. You get their direct cell phone number. You get their email. You might even meet them for coffee. Their promise isn't speed at all costs. It's guidance. Their target audience isn't necessarily the person who wants to do everything themselves on an app. It's the first-time homebuyer who is terrified and has a million questions. It's the self-employed business owner whose income isn't a simple W-2. It's the veteran who needs an expert to help them navigate the complexities of a VA loan. Guild's loan officers are expected to be more than just salespeople. They are advisors. They are supposed to be the steady, expert hand that guides you through the single most complex financial transaction of your life. They pride themselves on handling the tough cases, the loans that don't fit neatly into a digital box. Their entire value proposition is the human element, the expertise, the reassurance, and the accountability that comes from having a single point of contact who is personally invested in getting your loan to the finish line. So right away, you can see the fundamental clash of philosophies. We have the tech-driven, centralized behemoth promising speed and convenience versus the relationship-driven, decentralized network promising expertise and personalized guidance. One says, "We've built a perfect system." The other says, "You need a perfect guide." This is the core conflict we're going to explore. Is the sleek, frictionless experience of Rocket Mortgage truly better? Or does the old-school, hands-on approach of Guild Mortgage provide a safer, more reliable path to homeownership, especially when things get complicated? Which model actually saves you more money in the long run? And which one is more likely to leave you high and dry when problems inevitably arise? The answer isn't simple, and it's not the same for everyone. The right choice for a salaried software engineer with perfect credit buying a simple condo is going to be very different from the right choice for a freelance graphic designer with a fluctuating income who is trying to use an FHA loan. And that's why we're going so deep. We're going to move past the marketing slogans and the commercials. We're going to get into the nitty-gritty. We'll compare their interest rates and how they're determined. We'll break down their fee structures, from origination fees to processing fees to the junk fees you need to watch out for. We will analyze real customer reviews, the good, the bad, and the ugly, to see what people's actual experiences are like. We'll look at the types of loans they specialize in and, more importantly, the types of loans they struggle with. So we have the tech-savvy disruptor versus the established, relationship-focused veteran. But which one will actually get you to the closing table with less stress and more money in your pocket? The answer lies in the numbers and the details, and that's exactly where we're going next. A bare-knuckle breakdown of interest rates, origination fees, and the hidden costs they don't always advertise. Let's start with the big one. Interest rates. This is the number everyone obsesses over. The headline figure that lenders splash across their websites. But the interest rate is like the tip of an iceberg. It's what you see. But what's lurking beneath the surface is what can actually sink your financial ship. Rocket Mortgage, being a tech-first behemoth, often thrives on advertising competitive, eye-catching rates. Their entire model is built on volume and speed. They can analyze your data in seconds and spit out a rate. You can go on their app at midnight, punch in your info, and see a number. It's fast, it's slick, and it feels empowering. Guild Mortgage, on the other hand, operates with a more traditional relationship-based model. You're more likely to get a rate quote after a conversation with a loan officer. They'll want to understand your full story, not just the data points on a screen. Now, does this mean their rates are always higher? Absolutely not. In fact, sometimes they can be lower, especially for borrowers with unique situations that a simple algorithm might misunderstand. A recent layoff but a fantastic new job offer? A non-traditional source of income? Guild's human-centric approach can sometimes find flexibility where an algorithm sees a red flag. The key takeaway here is that the advertised rate is just a starting point. It's a marketing tool. The rate you actually get depends on your credit score, your down payment, the type of loan, and even the day you lock it in. And that brings us to the rate lock. This is a lender's promise to hold a specific interest rate for you for a set period, usually 30 to 60 days, while your loan is being processed. With Rocket, this is often a simple one-click process within their app. It's clean and efficient. But what if the closing gets delayed because of an issue with the seller? Extending that rate lock with a digital-first lender can sometimes feel like you're sending a message into a void, potentially incurring automated fees. With Guild, you're calling your loan officer the person you've been working with all along. They can often be more nimble, advocating on your behalf to get that lock extended, sometimes with more favorable terms because they understand the human context of the delay. So while Rocket offers speed, Guild offers a personal advocate. It's a fundamental difference in philosophy. But let's get back to that iceberg. The massive, hidden part under the water? That's the fees. This is where the real battle is won or lost. First up, origination fees. This is what the lender charges you for the service of creating, or originating, your loan. It covers processing, underwriting, and all the administrative work. Rocket Mortgage often bundles its costs and might present a single, streamlined origination charge. They might even advertise no origination fees on certain loan products, which sounds fantastic. But remember, there's no free lunch. That cost is often baked into the loan in another way, usually through a slightly higher interest rate. It's a numbers game. They're giving you a lower upfront cost in exchange for a slightly higher monthly payment over 30 years. Guild Mortgage is more likely to have a more traditional, itemized fee structure. You might see a 1% origination fee, which is a common industry standard. On a $400,000 loan, that's a $4,000 fee right there. Seeing that number in black and white can feel jarring compared to Rocket's slicker presentation. But this is where you have to be a savvy consumer. Is Rocket's no-fee loan with a 7.25% interest rate a better deal than Guild's loan with a $4,000 fee, but a 7% interest rate? Over 30 years, that quarter-point difference in interest can add up to tens of thousands of dollars, dwarfing that initial origination fee. You have to do the math. Then you have discount points. This is one of the most misunderstood parts of getting a mortgage. Think of it like this. You can pay extra money up front to buy a lower interest rate for the life of the loan. Each point typically costs 1% of the total loan amount and might lower your rate by about 0.25%. Rocket's platform makes this look incredibly simple. You'll often see a slider. Slide it to the right to pay more in points and watch your monthly payment go down. It gamifies the process. But it doesn't always tell you the most important thing. The break-even point. That's the point in time where the money you've saved from the lower monthly payment equals the extra cash you paid up front. If you plan on staying in the house for 15 years, buying down the rate might be a genius move. But if you think you might move or refinance in 4 years, before you hit that break-even point, you've just given the lender free money. A Guild loan officer is more likely to have this exact conversation with you. They'll ask, what are your long-term plans for this home? Do you see yourself here in 5 years? 10 years? They'll help you calculate that break-even point to see if paying for points actually aligns with your life goals, not just which option looks best on a screen. It's a strategic financial decision, not just a toggle switch in an app. Beyond origination fees and points, there's a whole universe of other closing costs. These are the so-called junk fees that can nickel and dime you. We're talking about application fees, processing fees, underwriting fees, courier fees, tax service fees, flood certification fees. The list goes on. This is where you need to get your hands on the official loan estimate document from both lenders. This is a standardized, government-mandated form that breaks down all the costs. When you compare a loan estimate from Rocket and one from Guild, you might see some stark differences. Rocket may group several charges under a single line item for simplicity. It looks cleaner, less intimidating. Guild's might be a longer, more granular list of every single charge. Neither is inherently better or worse, it's about what they reveal. The longer list from Guild might seem overwhelming, but it gives you more ammunition to question specific charges. You can ask, what is this $150 courier fee? Can we get rid of that? With a bundled fee from Rocket, it's harder to pick apart the individual components. This all culminates in the most important number on that loan estimate, even more important than the interest rate itself. The APR, or annual percentage rate. The APR is the truer cost of borrowing. It takes the interest rate and combines it with most of the lender's fees and charges, then expresses that total cost as an annualized percentage. This is the ultimate apples-to-apples comparison tool. You could have a scenario where Rocket offers you a 6.875% interest rate, and Guild offers a 7%. First glance, Rocket is the clear winner. But then you look at the APR. The Rocket loan, after factoring in its bundled fees and points, might have an APR of 7.15%. The Guild loan, even with its slightly higher interest rate and an itemized origination fee, might have an APR of 7.1%. In that scenario, the Guild loan is actually the cheaper option over the long run. The APR cuts through all the marketing, all the sliders and fancy graphics, and tells you the truth about what you're paying. So when we talk about the raw numbers, it's not just a simple question of which lender has lower rates. It's a complex equation. Rocket Mortgage offers a streamlined, simplified, and often digitally elegant presentation of these costs. For a straightforward borrower who values speed and a clean interface, this can be a huge plus. Guild Mortgage offers a more traditional, detailed, and conversational approach. For a borrower who wants to understand every line item and strategize with a human expert about long-term value, Guild's method provides a different kind of clarity. The cost of your mortgage is the single biggest factor in your home buying journey, but it's only half the story. The numbers on a page mean nothing if you can't actually get the loan approved and close on time. The process itself, the journey from application to getting the keys in your hand, is a minefield of its own. And this is where the differences between these two lenders become even more dramatic. We're about to enter the world of pre-approvals, underwriting, and the race to the closing table. It's a battle of algorithm versus human intuition, of automated efficiency versus personal touch. And who wins that battle could determine whether you get your dream home or lose it. So let's dive into the heart of the machine. Imagine this: you've just walked out of an open house. It's the one. The backyard is perfect. The kitchen is exactly what you dreamed of, and you can already see your life unfolding within those walls. But in today's market, you're not just competing with other buyers, you're competing against time. The listing agent says they're reviewing offers tomorrow. You need a pre-approval letter, and you need it now. You pull out your phone, maybe even right there in the car, and you open the Rocket Mortgage app. This is their home turf. The entire company was built for this exact moment. The interface is clean, intuitive. It feels less like a mortgage application and more like a high-end tech app. You start plugging in your information: name, address, social security number. It asks to link to your bank accounts. You agree, and through a secure portal, it instantly verifies your assets. It asks for your employer and income. You type it in. In the background, its powerful algorithm is working at lightning speed. It pings the credit bureaus for your score. It analyzes the data from your bank accounts. It runs your stated income against its massive database of economic and employment information. And then, in less time than it takes to order a pizza, a notification pops up. Congratulations! You're pre-approved for $400,000. A PDF of your official-looking pre-approval letter is ready to download and send to your real estate agent. Feels like magic. It's frictionless, empowering, and incredibly fast. This is the promise of Rocket Mortgage fulfilled. Speed and convenience, delivered directly to the palm of your hand. Now let's rewind that same scenario, but instead of opening an app, you make a phone call. You call a loan officer at Guild Mortgage. Someone answers. A real person. Let's call her Sarah. You tell Sarah you found the perfect house. She congratulates you. You can hear the genuine excitement in her voice. And then she starts asking questions. Not just the data point questions, but the why questions. She sees you've been at your job for 18 months. She asks about your previous employment to establish a 2-year history. You mention you're getting a gift from your parents for the down payment. She immediately explains the process for documenting that gift correctly so the underwriter will accept it. She has you send over your last 2 pay stubs, your last 2 W-2s, and your last 2 bank statements. It's more work up front. It's not instant. Sarah reviews your documents personally. She might call you back and say, "Hey, I see a large deposit here from 3 weeks ago. Can you tell me what that was?" You explain it was from selling your old car. She says, "Great, do you have a copy of the bill of sale and a copy of the deposited check?" The underwriter is definitely going to ask for that, so let's get it in the file now. This process doesn't take 10 minutes. It might take a day, maybe 2. But at the end of it, when Sarah sends you that pre-approval letter, it's built on a foundation of verified documents and human review. So now we have 2 pre-approval letters. One from Rocket, generated by an algorithm in minutes. One from Guild, crafted by a loan officer over a day or 2. You submit your offer. Turns out the seller received 3 other offers. It's a bidding war. The seller and their agent are now sitting at a table, comparing not just the offer prices, but the buyers themselves. They're looking for the strongest buyer, the one most likely to get to the closing table without any drama. They look at the Rocket Mortgage pre-approval. They know the name. They know it's fast. But experienced agents also know that this initial letter is often what's called a pre-qualification. It's based heavily on stated, unverified information and an automated check. It's a green light, but maybe a pale green light. Then they look at your offer with the pre-approval from Guild Mortgage. Your agent might have even had the loan officer Sarah call the listing agent directly. Sarah introduces herself, confirms that she has reviewed all your income and asset documents, and vouches for your strength as a buyer. She tells the agent, "This file is rock solid. We are ready to go." Which offer do you think the seller is going to favor, even if the prices are identical? In the world of real estate, certainty is currency. A pre-approval that has been vetted by a human being who can personally attest to the borrower's qualifications is often worth more than one generated by a faceless system. The Guild letter signals that the heavy lifting has already been done. The Rocket letter signals that the real work is just about to begin. This is the first critical fork in the road, where the difference in philosophy can mean the difference between winning and losing your dream home. But let's say your offer is accepted, regardless of which lender you used. Now the real race begins. Underwriting. This is the official, formal process where the lender verifies every single piece of information and gives the final stamp of approval on your loan. With Rocket, you move from the sleek, simple app interface into a document portal. You're assigned a team. You might get an email from one person requesting your W-2s, another person asking for your bank statements, and a third person handling the appraisal. When you have a question, you might call a general number or talk to a different person each time. The file moves down a digital assembly line. And this is where the speed of the initial pre-approval can create its first major bottleneck. Remember that large deposit from selling your car? The automated system didn't ask about it, but the human underwriter 3 weeks into the process has now flagged it. An automated request is sent to you. Please explain and source this large deposit. Now you're scrambling to find paperwork you didn't know you needed, uploading it to a portal, and waiting for someone you've never spoken to review it. The process can feel impersonal and reactive. The system works beautifully for straightforward, W-2 borrowers with perfect credit and a 20% down payment. But if your financial life has any complexity at all, if you're self-employed, have commission-based income, or a recent change in employment, that automated efficiency can quickly turn into a bureaucratic maze. With Guild, the underwriting process often feels quieter. Because you did all the work up front with Sarah, she already packaged your loan file with the underwriter in mind. She included the bill of sale for the car, and a letter of explanation for that deposit before the underwriter even had a chance to ask for it. She anticipated the questions. When the underwriter does have a question, they don't send an automated email to you. They contact Sarah. Sarah, who knows your entire financial story, can answer it immediately or call you to get the specific information needed. She is your advocate, your translator, and your single point of contact. She is insulating you from the stress of the process, managing the turbulence so you can focus on packing boxes. So we see two fundamentally different journeys to the same destination. One is a high-speed bullet train that's incredibly fast on the straightaways, but can be jarring and confusing if there are any curves in the track. The other is more like a guided expedition. A slower, more deliberate start, but with an expert guide who knows the terrain and has already planned for any potential obstacles. The question isn't just about speed. It's about the nature of the journey. What happens when something unexpected comes up? At Rocket, you risk becoming a ticket number in a complex system. At Guild, you remain a client with a dedicated advocate. In the biggest financial transaction of your life, that distinction can be everything. But what about the cost? All of this personalized, hands-on service from Guild must come at a premium, right? And surely Rocket's massive scale and technological efficiency must translate into lower rates and fees for the consumer. It has to. But what if it doesn't? The truth about who is actually cheaper and why is far more complex and frankly far more shocking than you might think. So let's pull back the curtain. When you compare two lenders, your brain instinctively wants to ask one simple question: who has the lower interest rate? And that is exactly what they want you to focus on. Because the interest rate is the shiny object, the headline, the number they splash across their commercials. But the real cost, the number that truly matters, is buried in a 3-page document that most people find so confusing, they just sign it without reading. This document is the loan estimate, and understanding it is the key to not getting fleeced. Think of it like this. You're buying a car. Rocket Mortgage is like the giant, national dealership with the flashy commercial advertising a car for an unbelievably low price. Guild Mortgage is the trusted, local dealership that people in your town have used for generations. You walk into the giant dealership, excited about the advertised price. But by the time you're done, they've added a destination charge, a dealer prep fee, premium floor mats, nitrogen in the tires, and a paint protection plan you never asked for. The unbelievable price is suddenly very, very believable. The local dealership, on the other hand, might have a slightly higher sticker price, but the number they give you is much closer to what you actually pay. The mortgage industry works the exact same way, but their version of dealer fees and paint protection is called closing costs. Your loan estimate is the official breakdown of these costs. It's a standardized form, meaning Rocket's looks exactly like Guild's, which is fantastic for us because it allows for a true apples-to-apples comparison. The most important section to start with is on page 2, Section A, Origination Charges. This is the lender's pure profit. It's what they are charging you for the service of creating your loan. This can be a flat underwriting fee, a processing fee, or a percentage of the loan amount called an origination point. 1 point is simply 1% of the loan amount. So on a $400,000 loan, a 1-point origination fee is $4,000. This is our first major point of comparison. Historically, big online lenders like Rocket Mortgage built their model on being the low-cost leader. They'd often advertise zero origination fees or very low flat fees. Their whole pitch was that their technology and scale created efficiencies that they passed on to you. Guild, with its more traditional people-heavy model, would often have a standard 1% origination fee. So, case closed, right? Rocket is cheaper? Not so fast. The game has changed. In today's market, it's not uncommon to see Rocket's fees in Section A be very similar, and sometimes even higher than Guild's. The key is to look at the total number in Section A. Don't get distracted by the name of the fee, processing, underwriting, origination, it doesn't matter. It's all just the lender's pocket. Add it all up. Who is charging more just to do the loan? That's question number 1. But this is where the magic trick begins. Because even if one lender is $1,000 cheaper in Section A, they can easily hide that $1,000 and more somewhere else. Let's look at Section B, titled Services You Cannot Shop For. These are required services, but the lender chooses the provider. This includes the appraisal, the credit report, flood certification, and other junk fees. This is a notorious hiding place. A lender might charge you $700 for an appraisal that only costs the appraiser $500. That extra $200? It goes to an appraisal management company, or AMC, which is often a sister company or an affiliate of the lender itself. It's a way to pad the bill with a fee that looks official and non-negotiable. Rocket, with its massive national scale, relies heavily on these AMCs. Guild, with its local-first approach, often has direct relationships with local appraisers, which can sometimes lead to a more transparent and cheaper appraisal fee. You have to compare these line by line. Is the credit report fee $30 or $90? Is the flood cert $5 or $25? It all adds up. Then you have Section C, Services You Can Shop For. This is primarily for title insurance and settlement services. This is the part where you technically have the right to choose your own title company. Now let's be honest, 99% of homebuyers don't have a favorite title company. They just go with who the lender or the real estate agent recommends. And lenders know this. Rocket Mortgage has a massive sister company called Amrock, which is one of the largest title and settlement providers in the country. It's an incredibly convenient, integrated system. When you get a loan with Rocket, they will almost always default to using Amrock. Guild, again, will typically have a list of trusted local title companies they've worked with for years. Is one better than the other? The convenience of Rocket's one-stop shop is undeniable. But bundling isn't always cheaper. It's critical that you get the fee sheet from the title company listed on the loan estimate and see if you can find a local competitor who can beat it. But all of this, the origination fees, the appraisal, the title insurance, it's all just the undercard. The main event, the place where thousands of dollars are won or lost, is in the complex dance between the interest rate and the fees. And this is where the shocking truth really lives. Lenders can give you literally any interest rate you want. You want a 2% rate when market rates are at 7? No problem. It'll just cost you. This cost is called discount points. Remember how an origination point was a fee to the lender for their service? A discount point is a fee you pay to the lender specifically to buy a lower interest rate. Again, 1 point equals 1% of the loan amount. Here's the scenario. You get a quote from Rocket for a 6.5% interest rate. You get a quote from Guild for a 6.75% rate. The obvious choice is Rocket, right? It's a 0.25% lower. But then you look at the loan estimates. Guild's quote has 0 points in Section A. Rocket's quote has 2 discount points. On that same $400,000 loan, that's an $8,000 fee due at closing that Guild is not charging. So which is the better deal? The lower rate from Rocket or the lower fees from Guild. To figure this out, you need to do a simple break-even analysis. First, calculate the monthly savings. The payment on a 6.5% rate is about $67 less per month than on a 6.75% rate. Now divide the cost of the points, $8,000, by the monthly savings of $67. The result is $119. That means it will take you 119 months, or just shy of 10 years, just to break even on the $8,000 you paid up front. If you plan to be in that house for 15 or 20 years, paying the points for the lower rate is a fantastic financial decision. But what if you think you might move or refinance in 5 years? You would have paid $8,000 to save only $4,000. You would have lit $4,000 on fire. This is the entire game. It's a seesaw. As the fees go up, the rate comes down. As the fees go down, the rate goes up. And lenders can set the pivot point on that seesaw wherever they want. They can even go in the other direction and offer you lender credits. This is where they give you money to help cover your closing costs, but in exchange you take a higher interest rate. Let's say you're short on cash. Guild might offer you a 7.25% rate, but give you a $4,000 credit at closing. This could be a lifesaver if it's the only way you can afford to close on the house. So who is cheaper, Rocket or Guild? The answer is, it's a meaningless question without context. It's like asking if a hammer is better than a screwdriver. It depends on what you're trying to build. The real question is, who is better at helping you understand the options and build the loan that's right for you? Rocket's system is built for speed and volume. It might default to quoting you a rate with points because it looks better in an email headline and gets you to click accept. The loan officer is managing dozens and dozens of files. Guild's model is built on conversation. The loan officer's job is to sit down with you, explain the break-even calculation, and ask the right questions. How long do you plan to be in this home? How much cash do you have for closing? What's more important to you? A lower monthly payment or lower cash out of pocket? The shocking truth isn't that one lender is secretly ripping you off. The shocking truth is that the mortgage itself is a complex financial instrument with multiple levers, and most consumers only ever look at one of them. The lender who wins is the one who can best align all those levers, rate, origination fees, third-party costs, and discount points, to your specific financial situation. And how they approach that process of alignment reveals everything about their philosophy, their culture, and ultimately the kind of experience you're going to have. Let's start with Rocket Mortgage. Their entire philosophy is built on a foundation of speed, simplicity, and scale. They are, in essence, a technology company that happens to do mortgages. This isn't an insult. It's the core of their value proposition. When you interact with Rocket, you're primarily interacting with their system, their algorithm. The fees are presented through this lens. The process is designed to be as frictionless as possible. You log in, you enter your information, and the system presents you with options. It's clean, it's modern, and it feels empowering. Their approach to fees is to bundle and simplify. You'll often see a single clear number for the cost to close. They've done the math for you. The origination fee, the application fee, the processing, the underwriting. It's all baked into a streamlined digital interface. This is fantastic for the user who wants a quick, digestible answer. You can pull a slider to adjust your down payment and instantly see the new numbers. You can click a button to see how buying discount points affects your monthly payment in real time. This is the user control part of their model. They give you the tools, the data, and the dashboard, and they trust you to make the right choice for yourself. It's the TurboTax of home loans. For a straightforward financial situation, a W-2 employee with a good credit score and a standard down payment, this system is incredibly efficient. It removes the intimidating jargon and presents a clear, cause and effect relationship between your choices and your costs. But this is also where the potential pitfalls of the tech-centric model begin to show. The algorithm is powerful, but it's not a financial advisor. It can't ask you about your 5-year plan. It doesn't know you're thinking of starting a business, or that you might receive an inheritance next year that could be used to recast the loan. The system is designed to solve the equation you give it right now. It's not designed to have a conversation about whether you're asking the right questions in the first place. Take discount points, for example. Rocket's interface makes it incredibly easy to pay points to lower your interest rate. You see the monthly payment go down and your brain gets a hit of dopamine. Feels like you're winning, but the system won't proactively sit you down and calculate your break-even point. It won't ask, "Hey, are you sure you're going to be in this house for the 7 years it'll take to recoup this upfront cost?" That level of strategic, forward-looking advice requires a human element that is secondary, not primary to Rocket's process. You can certainly talk to one of their loan officers, but their role is often to facilitate your journey through the existing tech platform, not to fundamentally redesign the journey for you. The philosophy is empowerment through data. The risk is that the user, armed with all this control, might not have the expertise to wield it optimally for their long-term benefit. The alignment is between you and the software, and it's a beautiful alignment, as long as your needs fit within the software's parameters. Now let's pivot to Guild Mortgage. If Rocket is a tech company doing mortgages, Guild is a mortgage company that uses tech. The emphasis is flipped. Their philosophy isn't built on an algorithm, it's built on a person, the loan officer. The entire process is designed to funnel you not into a dashboard, but into a conversation. From the very beginning, the goal is to understand your story. Where are you coming from? Where are you trying to go? Is this a starter home or your forever home? Are you an empty nester looking to downsize and minimize your payment? Or a young family looking to maximize your space, even if it means a higher payment for a few years until your income grows? This conversational approach directly shapes how they handle fees and loan structure. You're less likely to be presented with a slick interface with sliders and toggles. Instead, you're going to receive a document, a loan estimate, and a phone call. Your loan officer is going to walk you through it line by line. This can feel slower, more old-fashioned, and frankly, more intimidating than Rocket's clean UI. You'll see every single fee broken out. The loan origination fee, the processing fee, the underwriting fee, the credit report fee, title insurance, escrow fees, appraisal costs. It's a dizzying amount of information. But here's the critical difference. The Guild loan officer's job isn't just to present the numbers. It's to interpret them and strategize around them. They're not giving you the keys and a GPS. They are a professional chauffeur who knows the city inside and out. They might look at your situation and say, okay, I see you have enough cash for a 20% down payment, but you're a freelance graphic designer. Let's consider putting only 15% down. Yes, you'll have to pay private mortgage insurance for a while, but that extra 5% cash in your emergency fund is a critical safety net for someone with variable income. The peace of mind is worth more than the cost of the PMI. An algorithm can't make that kind of nuanced human judgment. A Guild loan officer can also get creative with the structure. They might say, instead of you paying for discount points out of pocket, let's look at a lender credit. We can give you a slightly higher interest rate, but in exchange, we'll cover $2,000 of your closing costs. This frees up cash for you to buy that new refrigerator you need. This is the art of loan structuring, not just rate quoting. It's about manipulating the variables on the back end, the fees, the credits, the points, to craft a loan that is uniquely tailored to your life circumstances, not just your FICO score. The downside to the Guild model is its variability. Your experience is almost entirely dependent on the skill, experience, and integrity of your individual loan officer. A great one is a financial wizard who can save you thousands and prevent catastrophic mistakes. A new or unmotivated one, however, can make the process confusing and costly. There's less standardization. The process relies on human expertise, and humans are imperfect. You have to place your trust in a person, not a system. For someone who is deeply private or prefers self-service, this mandatory conversation and reliance on a single point of contact can feel inefficient and intrusive. So let's put these two philosophies head to head. Rocket's alignment is about speed and efficiency. It's designed for the modern consumer who values control and wants to move quickly. They've perfected the mortgage as a product, a commodity that can be delivered through a superior technological pipeline. Their fee structure is designed for clarity and simplicity at the point of sale. Guild's alignment is about relationships and customization. It's designed for the consumer who values guidance and wants a trusted advisor. They treat the mortgage not as a product, but as a financial strategy, a pivotal piece of a larger life plan. Their fee structure is presented as a detailed breakdown, a starting point for a strategic conversation about what levers can be pulled to achieve a specific goal. One gives you the dashboard of a race car. The other gives you a seasoned co-pilot. Neither is inherently better, but they are fundamentally different. The choice between them reveals what you truly value in one of the biggest financial transactions of your life: the sleek, predictable perfection of a machine, or the nuanced, creative, and sometimes messy wisdom of a human guide. This philosophical divide doesn't just impact the fees you pay, it dictates the very products they are willing and able to offer you in the first place. Let's pull back the curtain on those products, starting with the 800-pound gorilla, Rocket Mortgage. When you land on their website, you're entering a world built for speed and scale. Their product menu is clean, concise, and designed to cater to the vast majority of American homebuyers. You'll find the essentials, the greatest hits of the mortgage world. First up, you have your conventional loans. These are the workhorses of the industry, not backed by the government, and typically requiring a decent credit score and a down payment of anywhere from 3 to 20%. Rocket's system is optimized for these. If you have a solid W-2 job, a good FICO score, and clear-cut finances, their algorithm can process you with breathtaking efficiency. Then you have the government-backed loans. There's the FHA loan, a favorite among first-time homebuyers because it allows for lower credit scores and a down payment as small as 3.5%. There's the VA loan, an incredible benefit for veterans, active duty service members, and eligible spouses, often requiring zero down payment. And there's the USDA loan for financing homes in eligible rural areas, also with a potential zero down option. Rocket offers all of these, and their platform makes the initial application for them incredibly simple. They also play in the high-end market with jumbo loans, mortgages that are too large to be sold to Fannie Mae or Freddie Mac. And they have their own proprietary, branded products like the Wow You Ridgage, which gives you the flexibility to choose a custom loan term, anything from 8 to 29 years. This is a clever, tech-forward solution that allows you to align your mortgage payoff date with a specific goal, like retirement. But look closely at this entire lineup. What do they all have in common? They are, for the most part, standardized products. They are quantifiable. They fit into neat boxes. Rocket's entire business model, the machine itself, is built on processing these specific, well-defined loan types at a massive scale. The system is designed to identify qualified borrowers for these programs and push them through to the closing table as fast as humanly, or rather technologically, possible. If your financial picture is a perfect square, Rocket has a perfectly square hole to fit you into. It's a model of efficiency. The trade-off is a lack of flexibility. The machine is not designed for nuance. If your situation is complicated, you might start to see the gears grind. What if you're a freelance artist with unpredictable income? What if you have a past credit issue that has a perfectly reasonable explanation? What if you want to buy a fixer-upper that needs $50,000 in renovations? For these scenarios, you're not just looking for a loan, you're looking for a solution. And that's where the philosophical divide between Rocket and Guild becomes a chasm. If Rocket built a superhighway for the most common types of cars, Guild Mortgage is more like a specialty garage, equipped to handle everything from a brand new electric vehicle to a classic muscle car that needs a custom engine rebuild. They offer all the same standard products as Rocket, conventional, FHA, VA, USDA, jumbo. They have to compete. But that's just the showroom floor. The real magic happens in the back. This is where Guild's decentralized, loan officer-centric model truly shines. Their primary mission isn't just to scale. It's to find a way to get the loan done. This means they have built an entire infrastructure around products that require a human touch, deep local knowledge, and creative problem-solving. Let's start with down payment assistance, or DAPs. These are programs often funded at the state, county, or city level that provide grants or second loans to help homebuyers cover their down payment and closing costs. For many people, this is the single biggest barrier to homeownership. Rocket's centralized model makes it incredibly difficult to be an expert in the hundreds, if not thousands, of hyperlocal DAP programs across the country. Each one has its own unique rules, paperwork, and eligibility requirements. Guild, on the other hand, lives and breathes this stuff. Their local loan officers are expected to be masters of their specific community's programs. They know the ins and outs of the California Housing Finance Agency's programs, or the Texas Department of Housing and Community Affairs grants. They can sit down with you, look at your income, and say, okay, you're eligible for this specific grant that just opened up last month, and here's exactly how we navigate the paperwork. That is a level of service and product access that a centralized call center simply cannot replicate. Next, let's talk about renovation loans. You find the perfect house, but the kitchen is straight out of 1972. A standard mortgage won't give you the extra cash to fix it. Guild specializes in loans like the FHA 203K or Fannie Mae Homestyle Loan, which bundle the purchase price and the cost of renovations into a single mortgage. These are complex loans. They require contractor bids, inspections, and a draw process to pay for the work as it's completed. It's a logistical puzzle that requires a skilled human quarterback to manage all the moving pieces. It's a product born from the philosophy of finding a way, not just following a script. But perhaps the single most important difference in their product offerings isn't a loan type at all. It's a process. It's called manual underwriting. In Rocket's world, your application is primarily analyzed by an automated underwriting system, or AUS. It's an algorithm. It looks at your credit score, your debt-to-income ratio, your assets, and it spits out a decision. Approve, refer, or deny. It's pure data, pure science. There is no room for a story. Guild, while they also use automated systems, has a robust capacity for manual underwriting. This is the art of lending. This is where a human underwriter sits down, looks at your entire file, and reads the story behind the numbers. Are you self-employed with a business that shows a paper loss for tax purposes, but you have fantastic cash flow? An algorithm sees the loss and says no. A human underwriter can analyze your bank statements, understand your business, and see the reality of your income. Did you have a medical emergency 3 years ago that tanked your credit score, but you've been a perfect borrower ever since? The algorithm just sees the low score. A human underwriter can read your letter of explanation, see the medical bills, and make a common-sense judgment. Are you a gig economy worker, a waitress who makes most of her money in cash tips, or someone with a non-traditional credit history? Manual underwriting is your lifeline. It's the ultimate expression of Guild's philosophy. They don't just see you as a set of data points. They see a person trying to buy a home. They have built their product suite and their internal processes around this belief. They offer bridge loans to help you buy a new home before you've sold your old one. They have lock-and-shop programs that let you lock in an interest rate while you're still searching for a property, protecting you from market volatility. These aren't just features. They are solutions to real-world problems. They are products that, by their very nature, require conversation, consultation, and expertise. So the choice in products is stark. Rocket offers a streamlined, efficient menu of the most popular loans on the market, perfect for the borrower who fits the mold. Guild offers that same menu, but also a whole workshop of specialty tools designed for anyone whose financial life doesn't fit neatly inside a box. One is a vending machine, offering predictable items with speed. The other is a restaurant with a chef, capable of taking your unique needs and crafting a dish just for you. So you have these two vastly different arsenals of financial tools. But what does it actually feel like to pick one up and try to build your future with it? What happens when you click Apply Now, or sit down in that loan officer's office? The experience of actually getting the loan, well, that's where the rubber truly meets the road. So let's start with Rocket Mortgage. The moment you land on their website or open their app, you feel it. It's clean, it's modern, it feels less like a bank and more like a tech company, which of course is exactly what they are. You click Apply, and you're not filling out a clunky PDF from 1998. You're entering a digital ecosystem. The process is gamified. Each step is a small victory. Link your bank account? Check. A green bar fills up. Authorize your employment verification? Check. Another piece of the puzzle clicks into place. You're not just applying for a loan. You're building it piece by piece right on your screen. They've created what's called a frictionless experience. They've identified every single point in the traditional mortgage process that causes people to slow down, get confused, or give up, and they've used technology to sand it smooth. You don't have to dig through file cabinets for 2-year-old tax returns. You just connect your IRS data directly through their portal. You don't have to guess what's next. A personalized real-time to-do list tells you exactly what they need from you and why. It's incredibly empowering. You feel in control. You can work on it at midnight in your pajamas or during your lunch break at work. The machine is always on, always ready for you. Communication is constant, but it's largely automated. You get texts when your status changes. You get emails when a document is approved. If you have a question, you can use their chat feature or call a number. And this is a key point. You'll likely talk to a team. You might speak with one person about your application, another about processing, and a third about your rate lock. They are all knowledgeable, but it's a call center model. The system is the star, and the people are there to help you navigate the system. For a self-sufficient, tech-savvy person who understands the basics and just wants to get from point A to point B as fast as possible, it is, without a doubt, a thing of beauty. It's a finely tuned engine. But what happens if that engine sputters? What if you have a unique situation? Maybe you're a freelance graphic designer with fluctuating income. Maybe you just received a large cash gift from a relative for your down payment. Suddenly, the slick, automated system might flag your file. You'll get a notification. Underwriting condition added. Please provide a letter of explanation for irregular income. You log in, you see the sterile request, and you have to figure out how to respond in a way that satisfies a faceless underwriter you'll never speak to. The feeling of control can quickly be replaced by a feeling of isolation. You're no longer building your future. You're just trying to satisfy the machine. Now let's flip the coin and look at Guild Mortgage. The experience couldn't be more different from the very first click. When you show interest in Guild, the goal isn't to get you into a system. It's to get you to a person. You're not assigned a case number. You're introduced to your loan officer. Let's call her Linda. Linda is not a call center employee. She is your dedicated point of contact from start to finish. Your first interaction is likely a phone call or an in-person meeting. And it's a conversation. Linda isn't just taking down your information. She's asking about your goals, your fears, your plans for the house. Are you planning to start a family? Is this a starter home or a forever home? She's a strategist, a financial counselor. The application process itself might feel a bit more traditional. You might fill out an online form, but Linda is there to guide you. If you get stuck, you don't message a help desk. You call or text Linda directly. When it's time to submit documents, you might use a secure online portal similar to Rocket's, but the request doesn't come from an algorithm. Comes from Linda. She'll email you saying, "Hey, we're going to need your last 2 pay stubs and bank statements. Just send them over when you have a chance, and let me know if you have any trouble finding them." It's a high-touch, human-centric process. This becomes critically important during the underwriting phase. Remember that freelance graphic designer with the weird income? With Rocket, they're uploading documents into the void, hoping they got it right. With Guild, their loan officer Linda would call them and say, "Okay, I'm looking at your income, and I know how underwriters see this. Let's frame this the right way. Let's get a profit and loss statement together. And let me help you write a letter that clearly explains your business. I'll present it to the underwriter myself to make sure they understand the whole picture." Linda is your advocate. She's your translator, speaking the language of underwriting on your behalf. She's not just processing your loan. She's fighting for it. The same goes for that large cash gift. Rocket system flags it and asks for an explanation. At Guild, Linda would have seen that on your bank statement during the initial conversation and said, "Oh, that's great, your parents are helping. We'll just need to get a simple gift letter from them. It's standard procedure, no big deal. I'll send you the form." She preempts the problem. She turns a potential bureaucratic headache into a simple item on the checklist. This difference in approach creates 2 completely different emotional journeys. The Rocket Mortgage journey is one of efficiency and independence. Its peaks are feelings of empowerment and speed. Its valleys are moments of potential frustration and isolation when things don't fit perfectly into the box. The Guild Mortgage journey is one of partnership and guidance. Its peaks are feelings of reassurance and confidence. Its valleys are moments where you might have to wait for your loan officer to get back to you. You're working on a human schedule, not a 24/7 server's. One puts a state-of-the-art dashboard in your hands and says, "You got this." The other puts an experienced guide in the passenger seat and says, "We got this." Neither is inherently better. They are built for fundamentally different types of people. The tech-forward borrower who values speed and autonomy will thrive in Rocket's ecosystem. The first-time homebuyer, the self-employed individual, or anyone who feels anxious about the process will find immense comfort and value in Guild's personal approach. The experience of getting the loan is about more than just submitting paperwork. It's about how you feel during one of the most stressful and significant transactions of your life. Do you want to feel like a capable pilot flying a cutting-edge jet? Or do you want to feel like a valued passenger with an expert captain navigating the turbulence for you? This difference in experience is stark. But does a smoother, more personal ride come with the higher price tag? When we peel back the curtain on the numbers, the rates, the fees, the closing costs, which lender actually saves you more money? The answer is complicated. It's complicated because the question, "Who is cheaper?" is fundamentally the wrong question to ask. There is no single static answer. A mortgage isn't like buying a television where you can just find the lowest price for the exact same model. The price of your mortgage is a moving target, a personalized quote built specifically for you, on a specific day for a specific property. The lender who is cheapest for your neighbor might be the most expensive for you. So instead of asking who is cheaper, the right question is, how do I figure out who is cheaper for me? And to answer that, we have to dissect the 2 biggest components of cost: the interest rate and the fees. Let's start with the big, shiny number everyone focuses on, the interest rate. You see them advertised everywhere. Rates as low as. It's the headline grabber. But that advertised rate is like a mirage in the desert. It's for a perfect borrower, someone with an 800 credit score, putting 40% down on a single-family home, with a debt-to-income ratio that would make a monk jealous. For everyone else, the rate is different. It changes daily, even hourly, based on the bond market. It changes based on your credit score, your down payment, your loan type, and even the type of property you're buying. This is where Rocket and Guild's philosophies on costs begin to diverge. Rocket Mortgage plays the game of scale and speed. Their goal is to offer a competitive rate instantly to millions of people. They leverage technology to analyze market data in real time and present you with a rate. Their big value proposition here is something called Rate Shield. This is a powerful tool. It allows you to lock in an interest rate for 90 days while you shop for a home. If rates go up, you're protected. If rates go down, you get the lower rate. It's a brilliant piece of marketing and a genuinely useful feature that provides peace of mind in a volatile market. The trade-off? Because they are a massive centralized machine, there's often less room for negotiation. The rate is the rate. It's calculated by an algorithm, and it's designed to be competitive enough to win your business without being so low that it hurts their massive volume-based profit model. Guild Mortgage operates on a different battlefield. They are also a large, national lender, but their structure is more decentralized. You're working with a loan officer in a branch, a human being whose job is to navigate the market for you. Their rates are also driven by the same market forces, but the process feels different. A good loan officer at Guild can look at your entire financial picture and strategize. They might say, listen, if you can pay off this one credit card, it'll boost your score by 15 points, and I can get you a rate that's an eighth of a point lower. That will save you $12,000 over the life of the loan. That's a conversation an algorithm can't have with you. They also have access to a wider variety of niche portfolio loans and down payment assistance programs that might not be in Rocket's automated system. So while they might not have a flashy program like Rate Shield, their value proposition is a custom-tailored rate based on expert human guidance. But here's the secret that most first-time homebuyers miss. The interest rate is only half the story. In fact, it's often the less important half in the short term. The real battleground, the place where thousands of dollars are won or lost, is in the fees. This is where you have to become a detective and scrutinize every line item. Every mortgage has closing costs, which are a cocktail of fees. Some are from the lender and some are from third parties. The most important fee to compare is the origination fee. This is the lender's direct profit for creating the loan. It can be a flat fee like $1,000 or a percentage of the loan amount, typically around 1%. Rocket Mortgage often bundles its lender fees into a single line item, which can make it easy to understand. Guild's fees might be broken out into processing and underwriting fees. Neither is better or worse, they're just different. But you have to compare the total of all the lender's direct charges. Then you have third-party fees for things like the appraisal, title search, title insurance, and credit report. Now, lenders will tell you they don't control these costs. And that's partially true. But they do choose the companies they work with. A massive lender like Rocket can often negotiate bulk discounts with appraisal and title companies, potentially passing those savings on to you. On the other hand, a local Guild branch has long-standing relationships with local appraisers and title agents who know the area inside and out, which can prevent costly delays or mistakes. So how on earth do you compare all of this? A low rate with high fees versus a higher rate with low fees? It's designed to be confusing, but the federal government has given you a secret weapon. It's called the loan estimate. This is a standardized 3-page document that every single lender is legally required to give you within 3 days of you submitting an application. This document is the great equalizer. It forces every lender to show you their numbers in the exact same format, so you can compare them apples to apples. Getting a loan estimate from Rocket and a loan estimate from Guild is the single most important thing you can do to find out who is truly cheaper. Don't look at their marketing emails. Don't listen to their pre-approval letters. Look at the loan estimate. Specifically, look at page 2 in box A, origination charges. This is the lender's direct fee. This is their profit. Compare that number between Rocket and Guild. This is the purest comparison of the lender's cost. Then you need to look at the interest rate in the top left of page 1 and see if there are any points. This is a trap that snares so many buyers. A lender can offer you a magically low interest rate, but they're charging you discount points to get it. 1 point costs 1% of the loan amount. So on a $400,000 loan, paying 1 point costs you $4,000 in cash at closing. It's essentially prepaying interest. Sometimes it's a great deal if you plan to stay in the home for a long time, but you have to do the math. Calculate your monthly savings from the lower rate and divide it into the cost of the points. That tells you your break-even point. If it takes you 8 years to break even and you only plan to be in the house for 5, you just lost thousands of dollars. Let's make this real. Imagine a borrower. Let's call her Sarah. She's a 30-year-old software developer with an excellent credit score and a 20% down payment. She values speed and a frictionless digital experience. She applies to Rocket and gets a loan estimate with a 6.5% interest rate and $1,500 in origination fees. She applies to Guild and their loan estimate shows a 6.625% rate, but only $500 in origination fees. Who is cheaper? For Sarah, who wants to minimize her cash at closing, Guild might feel cheaper upfront, but the higher interest rate will cost her more every single month for 30 years. Rocket is more expensive at the closing table but cheaper over the long haul. Now consider another borrower, David. He's a veteran using a VA loan and he's self-employed with fluctuating income. His situation is complex. Rocket's algorithm might struggle to verify his income, leading to delays or a higher rate. He goes to a Guild loan officer who specializes in VA loans and manual underwriting. The loan officer spends hours restructuring David's file. They get him a competitive rate, and because Guild has a special promotion for veterans, they waive the entire origination fee, saving him $3,000. In this case, for David's specific, complex situation, Guild is undeniably the cheaper and better option. The bottom line on cost is this: there is no champion. There is no single winner. The winner is the borrower who does their homework. The winner is the person who understands that the only way to know for sure is to apply to both lenders and compare their official loan estimates side by side. You have to look at the total lender fees in box A, you have to understand if you're paying points for your rate, and you have to calculate your total cash needed to close. Choosing a lender based on a TV commercial is like choosing a surgeon based on their billboard. The real work happens behind the scenes, in the numbers. And getting those numbers in black and white is your non-negotiable first step. But even after you've signed on that dotted line, after the ink is dry and the keys are in your hand, the relationship with your lender isn't over. In fact, it's just beginning. What happens to your loan after it closes? Who do you send your payments to every month for the next 30 years? And what happens if they sell your loan to some company you've never even heard of? The answer to that question reveals the final crucial difference between these two mortgage giants. This is the moment of truth in any mortgage journey. The part almost nobody thinks about until it's too late. You see, getting the loan is just the beginning. It's the starting line. The race itself is the next 15, 20, or 30 years of making payments. And the company that manages that race, the one that collects your money, pays your taxes and insurance from escrow, and answers the phone when a hurricane floods your basement, is called your loan servicer. And here's the dirty little secret of the mortgage industry. The company that gives you the loan is often not the company that services it. Think about it. You spend weeks, maybe months, building a relationship with a loan officer. You trust them. They guide you through the single biggest purchase of your life. You sign a mountain of paperwork at closing, shake hands, get the keys, and you feel a sense of loyalty. This is your lender. Then, 30 days later, you get a letter in the mail with a generic logo you don't recognize. It's called a notice of servicing transfer. It calmly informs you that your loan has been sold. Your relationship, that trust you built, gone. Poof. Vanished. You're now the customer of a company you've never heard of, based in a state you've never been to, with a customer service department that's probably in a different time zone. The terms of your loan, your interest rate, your monthly principal and interest, they can't change. That's protected by law. But everything else? The quality of service, the ease of making payments, the competence of the people handling your escrow account, that is now a total unknown. It's like you meticulously picked out the perfect family doctor, and a month later you're told you've been permanently reassigned to a massive, understaffed clinic run by a faceless corporation. This is where the fundamental philosophies of Rocket Mortgage and Guild Mortgage diverge in the most profound way. This isn't about apps or interest rates anymore. This is about the long-term commitment. Let's start with Rocket Mortgage. Rocket isn't just a mortgage originator. They are one of the largest mortgage servicers in the entire country. Their business model is built on a simple, powerful premise. We want to own the entire customer lifecycle. From the first click on their website to the very last mortgage payment you make 30 years from now, they want you inside the Rocket ecosystem. When you get a loan with Rocket, there is a very, very high probability, we're talking well over 90%, that Rocket will service that loan for its entire life. They don't just want to date you, they want to marry you. The advantage of this is monumental consistency. The slick, easy-to-use app you use to upload your documents is the exact same app you'll use to make your payments. The online portal where you track your loan's progress is the same portal you'll use to check your escrow balance or download your year-end tax statements. There is no jarring handoff. There is no goodbye and good luck letter. The experience is seamless, integrated, and predictable. For someone who values efficiency and a powerful, all-in-one digital platform, this is a dream scenario. You have one account, one login, one company to deal with. It is the Amazon of mortgages. A massive, streamlined, tech-driven machine designed for volume and efficiency. But that scale is also its potential weakness. When you are one of over 2.5 million servicing clients, are you a person or an account number? If you have a complex problem, say, an issue with your property tax assessment causing a massive escrow shortage, you're not calling up your local loan officer. You're calling a national servicing center. You're likely navigating a phone tree, speaking to a representative in a cubicle farm who is working through a script, and who may not have the autonomy to solve a unique problem on the spot. It can be incredibly efficient for standard questions, but potentially frustrating for non-standard issues. The experience is designed to be uniform, which means it can feel impersonal. It's the trade-off for that incredible technological convenience. Now let's turn to Guild Mortgage. If Rocket's model is a marriage of convenience and technology, Guild's is a marriage built on a personal relationship. Guild's philosophy is almost identical to Rocket's in one key respect. They also believe in servicing the loans they create. They have built their reputation for over 60 years on the idea of being a lifetime lender. They don't want to just originate your loan and sell you off to the highest bidder. They want you as a customer for life. They want to handle your first home, your refinance when rates drop, and the loan for the vacation home you buy 20 years from now. And the only way to do that is to maintain the relationship. So, like Rocket, Guild services the vast majority of the loans it originates. They have a very high servicing retention rate. But their approach to that servicing is fundamentally different. It's what they call high touch. The goal isn't just to efficiently collect a payment through an app. It's to maintain the human connection. While they have online portals and payment options, their strength lies in their accessibility. If you run into an issue, the culture of the company encourages a more personal resolution. You're more likely to find a direct line to a knowledgeable person who can look at your specific situation, rather than just a massive call center. They are trying to deliver the service of a local community bank, but at a national scale. The potential downside? Guild's technology, while perfectly functional, may not feel as cutting-edge or all-encompassing as Rocket's integrated digital universe. Their online portal and app get the job done, but it's not the core of their identity in the same way it is for Rocket. The focus is on people first, technology second. For some, this might feel slightly less convenient than Rocket's one-stop-shop app. The promise is a better human experience, but it rests on the execution of thousands of individual employees, whereas Rocket's promise rests on the flawless execution of its code. So what does this all mean? It means that with both Rocket and Guild, you are largely protected from the biggest fear in the mortgage world: being sold off to a random, low-quality, third-party servicing company. These nightmare servicers exist purely to collect payments as cheaply as possible. Customer service is a cost center, not a feature. They are notorious for escrow errors, lost paperwork, and endless phone holds. Choosing Rocket or Guild is a strategic move to avoid that fate. You are actively choosing your long-term partner. The real decision isn't about if your loan will be serviced well, but how. It's a choice between two distinct flavors of excellent in-house servicing. Do you want the Apple or Amazon experience? A beautiful, seamless, and powerful tech platform that manages everything for you with incredible efficiency, but where human interaction is secondary to the system. If that's you, Rocket Mortgage is your clear choice. They have perfected the art of digital mortgage servicing. It's clean, it's predictable, and it just works. Or do you want the boutique, concierge experience? A relationship where you feel you can pick up the phone and talk to a person who cares, where the company's culture is built around human connection and lifetime value, even if the tech isn't quite as dazzling. If that's you, Guild Mortgage is built from the ground up to deliver exactly that. This is the final and perhaps most important piece of the puzzle, because a low interest rate is fantastic for a month, but a great servicing experience is peace of mind for 30 years. We've now broken down the technology, the people, the loan products, and the long-term relationship. We've seen the DNA of two of the best lenders in the country. One a tech titan, the other a relationship champion. So, with all this information, how do you make the final call? Who is the ultimate winner in this head-to-head battle? It's time to put it all on the line. We're going to run through specific borrower profiles, the first-time buyer, the veteran, the self-employed entrepreneur, and declare a definitive winner for each. The final verdict is next. Alright, let's start the clock. First up, the first-time buyer. Let's call them Maya and Ben. They've been saving for years, scraping together a down payment while battling rising rents. They're smart, but they're also nervous. They don't know what they don't know. They've heard about FHA loans and down payment assistance programs, but it feels like a different language. They crave guidance. They need a navigator. For Maya and Ben, the choice is clear. This is Guild Mortgage's arena. Why? 3 words: the human element. While Rocket's app is slick, it can't replicate the experience of sitting across a desk from a local loan officer who knows the specific down payment assistance programs available in their city, their county, their state. Guild has built its entire reputation on this. Their loan officers can connect Maya and Ben with programs like the FHA Advantage or state-specific housing finance agency grants that can cover their entire down payment. This isn't just a transaction for them. It's a consultation. Rocket can do FHA loans, absolutely. But Guild specializes in the high-touch educational process that first-time buyers desperately need. They can explain the difference between mortgage insurance premiums and homeowners insurance, and they'll do it over the phone or in person until it clicks. For the buyer who needs a partner, not just a platform, Guild Mortgage takes the win. Next, the veteran. Meet Sergeant Miller. He's transitioning out of the military after a decade of service. He wants to use his VA loan benefit, a right he has earned through sacrifice. He's disciplined, organized, and comfortable with technology, but he wants to ensure he's maximizing every single dollar of his benefit. He wants 0 down, no PMI, and a competitive rate. This is a heavyweight fight. Rocket Mortgage is one of the largest VA lenders in the entire country. Their process is a well-oiled machine, built for speed and efficiency. They can get a VA loan from application to closing at a blistering pace, which is a huge advantage in a competitive housing market. But Guild isn't a slouch here either. They have a deep, institutional commitment to VA loans, often hosting seminars for veterans and working closely with the military community. A Guild loan officer might be a veteran themselves, someone who has walked this exact path. They can explain the nuances of the VA funding fee, eligibility requirements, and how to get the certificate of eligibility. So who wins? This is the toughest call. It comes down to the veteran's priority. If Sergeant Miller's top priority is a lightning-fast, digitally native process where he can upload documents from his phone at 10 p.m., Rocket Mortgage has a slight edge. Their scale and technology are purpose-built for that kind of efficiency. However, if his priority is a deeper, more personal consultation on how to best leverage his benefits for his specific financial situation, Guild is an incredibly strong contender. For its sheer volume, streamlined process, and speed, we're giving a razor-thin, photo-finish victory to Rocket Mortgage, but with the massive asterisk that a veteran seeking a more personal guide should absolutely put Guild at the top of their list. Now let's talk about the self-employed entrepreneur. This is Maria. She runs a successful e-commerce business she built from the ground up. Her income isn't a neat and tidy W-2. It's a complex tapestry of 1099s, quarterly tax payments, business write-offs, and fluctuating revenue. Last year was great, the year before was a building year. To a standard algorithm, her financial picture looks chaotic. She needs a lender who can see the story behind the numbers. This scenario is an absolute, unequivocal landslide victory for Guild Mortgage. Rocket Mortgage's greatest strength, its algorithm-driven, automated efficiency, becomes its greatest weakness here. Their system is designed to process standard applications at scale. When it sees non-traditional income like Maria's, it can often stall or issue an outright denial, not because she isn't qualified, but because she doesn't fit into the neat little box the algorithm needs. Guild, on the other hand, lives for these scenarios. Their commitment to manual underwriting means a human being, an experienced underwriter, is going to look at Maria's entire file. Her Guild loan officer will act as her advocate, helping her package her profit and loss statements, bank records, and business projections to tell a compelling story of a thriving business. They understand that a business expense that reduces taxable income is not the same as a lack of cash flow. They can work with bank statement loans or alternative documentation that Rocket might not even offer. For any borrower with a complex, non-traditional, or story income, Guild Mortgage isn't just the better choice. It's often the only choice. Finally, the savvy refinancer. This is Tom and Sarah. They bought their house 5 years ago. They have excellent credit, stable W-2 jobs, and a ton of equity. They're not looking for a financial education. They know their numbers cold. They're watching interest rates like a hawk, and they're ready to pounce to lower their monthly payment or pull cash out for a home renovation. Their number one priority is a low rate and a fast, frictionless, hassle-free process. They don't want to talk to anyone unless it's absolutely necessary. This is Rocket Mortgage's Super Bowl. This is the exact customer their entire multi-billion-dollar platform was designed for. Tom and Sarah can go on the Rocket app, link their bank accounts, have their income and assets verified automatically, and get a firm approval in minutes. They can lock their rate online, upload the few documents required, and track their loan's progress 24/7 in a slick, easy-to-understand interface. The process is so streamlined they might only ever speak to a human being to schedule the closing. There are no unnecessary meetings, no endless phone tag. It's pure, unadulterated efficiency. Guild can certainly do a refinance, but they can't compete with the sheer technological velocity of the Rocket platform for a straightforward, vanilla loan like this. For the tech-savvy borrower who values speed and a hands-off digital experience above all else, Rocket Mortgage is the undisputed champion. So, after all of this, who is the ultimate winner in the battle between Rocket Mortgage and Guild Mortgage? The truth is, the question is flawed. There is no single winner. The real winner is you, the educated borrower, who now understands that the best lender is not a universal title. It's a deeply personal choice that depends entirely on who you are. If you are a digital native with a straightforward financial life, and your top priority is speed and a seamless technological experience, Rocket Mortgage was built from the ground up for you. If you are a first-time buyer, self-employed, have a complex financial story, or you simply value a human relationship and expert guidance to navigate the maze of home financing, Guild Mortgage is your champion. And that brings us to the single most important piece of advice in this entire video. Do not just pick one. The ultimate power move you can make as a homebuyer is to make them compete for your business. Apply to both. And no, this will not destroy your credit. Multiple mortgage inquiries within a short period, typically 14 to 45 days, are treated by the credit bureaus as a single event. It's called rate shopping, and they expect you to do it. So go to Rocket's website and run through their digital application. At the same time, find a local Guild Mortgage branch and schedule a call with a loan officer. Get a loan estimate from both. Compare them line by line, the interest rate, the APR, the lender fees in Section A. See who offers you the better deal. See whose process feels right for you. The goal isn't to declare one company universally superior. The goal is to find the right loan from the right partner for the biggest purchase of your life. By understanding their core strengths and weaknesses, you've just transformed yourself from a passive applicant into an empowered consumer who is now in the driver's seat. You now know the game. Now go out there and win it.